Hey, what is up? I am Matt Drouin. I am a commercial real estate investor, and you are not going to want to miss this video. Thinking of doing a cash out refinance or selling smaller property and doing a 1031 exchange to free up equity to put down on a larger real estate deal, you need to stop right now. Don't move a single muscle until you watch this video, all right? Who am I and why should you even listen to me? All right. I've been investing in income producing property for over 18 years, based out of Rochester, New York. I have basically specialized in using the BRRRR strategy, using other people's money, the buy, rehab, rent, refinance, repeat. I graduated onto larger income producing commercial property. And one of the things I ran into, there was what I should have known much earlier on because I didn't ask for help, was the fact that as you grow bigger and you actually grow your relationship with community banks and then graduate into regional banks, there's a big lie out there that a lot of investors put out there, and that it doesn't matter about you, the borrower. It is the commercial lending only focuses on the actual property. So does it cash flow? Does it appraise? If yes, then good to go. We don't care where you get the down payment money from. We don't care about your liquidity. We don't care about your balance sheet or anything like that. That is totally false. I, was able to acquire my first couple of smaller commercial deals being asset rich and cash poor. But as you become a larger exposure to banks, they become more scrutinizing on you as the borrower. All right. So this happened to me and it bit me in the butt, and it greatly hamstrung my ability to exponentially scale my portfolio. All right. And it blew up in my face. What happened is I refinanced a group of small multifamily properties with the idea that I would use the cash out proceeds to put down on a larger deal. I did that, but it blew up my liquidity and hamstrung me in the pursuit of my next deal, right? I did that. I was able to acquire a great deal, so this is what a personal financial statement looks like when you're applying for commercial financing, all right, on a bank. What you want to do is right here, the banks really don't care about your annual income and your annual expenditures. All right. So I wouldn't be too worried about this. Myself, I'm a full-time real estate investor for probably about 11 years now. So I don't really declare any income whatsoever. So this is not important. What is really important down here is your assets and your liabilities. Most important is this stuff right here in terms of cash, readily marketable securities. That is, your stocks, bonds, mutual funds, ETFs, that type of stuff that can get converted to cash today. All right. This is really the crux of the stuff that's really important in terms of maintaining that fortress balance sheet that lenders want to see as you grow your relationships with them. Because what happens is you may be able to get by with buying your first couple of, smaller commercial deals with a local community bank, and they're really not going to be as scrutinizing on you. Regulation comes in when, the Fed regulates all of the banks in this country, the Federal Reserve. And when these banks start to get larger exposures to certain borrowers that are they have relationships with, what ends up happening is the Fed requires the banks to exercise a certain amount of due diligence to prevent them from having large exposures to any particular investor, right? So this is why you may have not gotten, scrutinized up into this point in time, right? But it will happen if you're looking to scale. So this is what an actual personal financial statement looks like. So what I'm looking to do is I'm actually looking to take the cash out of the properties that I sell. The properties I refinance, and just stick it right in my balance sheet. Now, this might be counterintuitive from the standpoint of, well, I don't have a deal lined up, so why do I want to do a cash out refinance and have it on my balance sheet? The problem is that when you're going for acquisition financing on a property, and you have your equity trapped in your real estate deals, this is not going to show up on your personal financial statement. Unless you commit perjury, right? So let's say you are buying $1 million property, all right, and you need $200,000 to put down on the deal. All right. So if you don't show either in cash or readily marketable securities, or let's say net cash surrender value of life insurance. Okay. So if you have a whole life policy that has a cash value on it, that is actually considered liquidity in most banks' eyes. So you can actually use that on there. If you can't show that, then you're going to have some issues with obtaining the financing in larger and larger deals. So you want to always be in consideration of what your liquidity position is and keep growing that exponentially over time. So that's the first step. Refinance high equity properties, pull the cash out, stick it in your balance sheet. All right, so the next thing you want to do is you're going to want to use OPM, other people's money, to buy your first string of larger deals. And the reason why you don't want to use your own cash is just for all the other aforementioned reasons, okay? You want to be able to maintain the strength of your liquidity, all right? If you don't, then sometimes these banks will require you to bring on an equity partner that has the balance sheet, all right? And that is an expensive signature to have to get, all right? So using the system or this method allows you to avoid all of that, all right? The next step is once you acquire a critical mass of these larger investment properties using OPM or other people's money, let's say if you've acquired, let's say $5 million worth of holdings, then you can actually get what's called a cost segregation analysis on those larger properties. A cost segregation analysis is essentially where you hire a company, an engineering company, to basically break up all the components of the property, and you're able to accelerate the depreciation and generate phantom losses much quicker and in bigger chunks than you could if you were just writing the normal depreciation schedule on residential multifamily, which is 27.5 years or 39 years for commercial properties. Now, those massive losses you can get can be banked and carried forward in the future. And I'm going to go in the next step as to why that's important right now. So now let's say you've acquired built a portfolio of, let's say you bought a $1 million property for your first deal, a $3 million property for your second deal, and then another $1 million property. Okay, so let's say you have $5 million worth of commercial real estate holdings. One thing is going to happen is a lot of times, this happened to me when I was an investor, I was like allergic to selling or even the idea of selling the properties that I had bought early on in my investing career. What happens is when you start witnessing the results and the financial outcomes with buying larger commercial property, you're going to be like, those old properties are old news. I don't want to have anything to do with them anymore because the opportunity cost of those, even having a mental real estate in my head, is not worth it. All right. So what you're going to do is, now remember, you've had some net loss carry forwards that are banked. All right. So you can actually start to harvest those. And how you harvest those is you sell strategically those investment properties. And these can be 1 a year or 2 a year. You have to talk to your CPA in terms of a tax strategy of how you want to transition your portfolio from small residential to larger commercial deals. So what you're going to be able to do is you can harvest those net loss carry forwards and wash the capital gains you have on your smaller properties. So you never have to do a 1031 exchange. This is kind of a lazy 1031 exchange, all right? So what ends up happening is that since you're not doing a 1031 exchange and then basically taking that equity and putting it into another property, and you're not satisfying that exponential growing of your liquidity position, then this will allow you to transition out of your smaller properties that probably pay you chump change compared to what you're doing now and into larger deals, tax-free, while strengthening that liquidity position that I mentioned is so important. So step 5 of the CBSO method involves this, and this is going to blow your mind, is you're going to want to refinance your larger properties every 5 to 7 years, pull cash out of them and stick it on your balance sheet. I'm going to show you the power of this, and we're going to use the example of a $1 million property that you bought, right, using OPM. Okay, the first string of capital events on this deal for the acquisition is going to be refinance the property, buying something that has enough value add potential to be able to refinance the property less than 5 years and give your investment partners 100% of their money back. Okay, so after you've gone through that cycle, this is after that, right? So with this, you've got the property stabilized. Let's say it is the net operating income is appreciating 3% per year. And so, and I just have this example right here on this before tax cash flow analysis. So you're going to have, this property that is going to be appreciating on this schedule right here, right? So if we look at the actual terminal value of the property, this is assuming, on the NOI, net operating income, it's an 8.5% cap rate. So we're assuming that we have a value increase up to $1.15 million, all right? So on this $1 million property at, year 5, you can actually pull $187,000 in cash out of that property. All right. So if you can imagine doing this and imagine you're stacking these deals on top of each other, right? From $1 million property, $2 million property, $5 million property, every single year as you stack and stagger these, you're going to be able to pull hundreds of thousands of dollars out of your properties and stick it on your balance sheet, so that you can actually grow this thing exponentially and really put your portfolio on steroids while being able to keep 100% of the equity or giving up very little equity in the process, while actually growing your relationship with these banks and keeping them happy at the same time. So And then I'm going to go on the next step in terms of what specifically to do with that cash. Okay, so you're building this cash or cash equivalents in your balance sheet exponentially over time as you're doing this and scaling, okay? So what do you do with that cash? All right, what I choose to do, and you want to talk to a financial advisor associated with this, is that I'm going to tell you what I do. So I take that cash and I invest it in low volatility securities, and I keep it at brokerage houses that offer attractive terms for what's called S blocks, or securities-based line of credit. And with a securities-based line of credit, let's say if you have $1 million at your brokerage house, is that you can actually set up a line of credit that's up to 80% of the loan to value of the securities in those portfolio. So you can actually have in this example, you can have an $800,000 line of credit that grows as you are putting cash on your balance sheet, or cash equivalents in your balance sheet, right? All while keeping your money working hard for you. Now, there's a lot of real estate people out there that are completely, turned off to the stock market and that sort of thing. Liquid securities are going to be very important if you're looking to build a portfolio that's, 10, 20, $50 million. All right. They're going to have to play a part in your strategy, either that or whole life policies through life insurance, right? So I want to have actual control over the investments that are in my portfolio. So I choose to actually build up my cash equivalents through using this method. Okay. And what that line of credit can actually do for you is that you can actually draw on that line. Let's say if you're short on a capital raise in the future, you have a $500,000 raise and you're only able to raise $300,000 of it, then you have a line of credit to draw on, right? That's 100% your discretion to do that. It's 100% your power. If you have a rehab that goes over budget, it just gives you the flexibility so that you can actually keep your business going and all at the same time, right? Is that when we go back to that personal financial statement, remember, the bank wants to see that you have the liquidity. They do not care that you have a line of credit as well against that liquidity. All right, so you can draw on that line of credit, and you can actually still maintain that cash liquidity that banks want to see. So definitely let me know your thoughts below. I put a ton of educational content out there, so definitely be sure to comment any of your questions, any type of material you want to see in the future. I put these videos out on the regular and would love to get your feedback. And definitely, if you are a experienced real estate investor looking to scale into the larger commercial deal space and you want to talk to me directly one-on-one, how I might be able to help you in your pursuit of larger deals and earning financial freedom, definitely check the comments below and so you can learn how to get in touch with me.